lazy, simple, and efficient. 3 words to describe Vanguard's 3-fund portfolio strategy, the most popular way of investing by Boglehead. Watch this video to learn all about this investment strategy and how you can do it yourself. Hi guys, I hope you're all doing well. So the 3-fund portfolio, or known as the lazy portfolio, is very popular and very much loved by the Boglehead community. Bogleheads are investing fans inspired by Vanguard founder John Bogle. Currently, there are over 100,000 Bogleheads across the world. So back to what the investment style really is. So it's very simple way of investing. You basically invest in 3 different very low-cost index funds, and they're supposed to give you exposure to over 15,000 different securities worldwide. And by investing in this way, you're expected to get a much higher risk-adjusted returns. And by risk-adjusted return, we're talking about high level of return with low level of risk compared to returns and risk generated by other professional active fund managers or amateur investors. If you're not very sure about the difference between index fund, ETF, and mutual fund, which are generally managed by active fund managers, then feel free to check out a video I've done previously. But just to put it very simply, an index fund is type of investment which is expected to follow the overall stock market or part of the stock market. For example, you can invest in an index fund that tracks the S&P 500, or you can invest in an index fund that tracks the performance of FTSE All-Share Index. So back to the lazy portfolio. The first fund should be your home stock market, and the second fund should be an international stock market, and the third or the final fund should be your home bond market. By home, we're talking about where you live. So if you live in the States, then your home stock market would be represented by, say, S&P 500. And if you live in the UK, then your home stock market should be represented by, say, FTSE All-Share or FTSE 100 index. Now, although we have these 3 different types of funds, how you actually allocate money across all 3 different types will really depend on you, and it will vary person to person. We'll get to that in a bit. But firstly, why invest in such a way? So what are the benefits with investing in 3-fund portfolio? Firstly, is the diversification. Since you're investing in an index fund which is tracking more than 15,000 securities, you're getting plenty of diversification. So you don't have to lose your sleep over what is happening to a single stock which can blow up or lose its value by 50%. Your level of return will be smooth as it is pretty diversified. And secondly, this investment style gives you a very balanced long-term approach. So you don't have to worry about any concentration risk on any style or industry. So as you may know that the stock market performance can be described in different types of style. For example, growth style or value style. Over the last 12 years, the growth style of investment have outperformed the value style of investment. And before that, it was the value investing style which did much better than the market or the growth style. But since you are investing in an index fund that's tracking the overall market, you don't have to worry about which style is doing better. And the second advantage is all to do with cost. Since you're investing in an index fund, it is the most cost-efficient way to invest your money. And then we have the fourth advantage, which is all to do with how easy it is to rebalance this portfolio. Since you only ever have to worry about 3 different types of funds, it's going to be really easy for you to rebalance your portfolio. By rebalancing, we're talking about that your actual portfolio is within target. So for example, say your target allocation is 50-50 between home stock market and international stock market. And say your international stock market did very well and your portfolio now looks to be more like, say, 30-70, then all you have to do is sell the international stock market fund and put that money in your home stock market fund to bring the allocation down to 50-50. And you can do this very simply as you only have, say, 2 funds to worry about in this example. And finally, which I think is the most important benefit of investing this way, is your peace of mind. Following this 3-fund portfolio means you can literally just invest and forget. You don't have to worry about what's happening to the market. You are literally sticking to your 3-fund portfolio and allocating it, rebalancing it as and when required. Not having to worry about daily market volatility is such a blessing, and that's the way investment should really be for the long term. So this method gives you a very simple, very easy and efficient way of getting the stock market exposure in the best way possible. So this 3-fund portfolio pretty much ticks all the great boxes when it comes to investing. So now let's talk about how you can actually build it yourself, starting with asset allocation. This refers to how you're allocating money across 3 different types of funds. Do you want to do 1/3 each, or do you want to do, say, 80-20 or 20-80? This very much depends on you and you only, and things that are personal to you. So your objective, including your time horizon, your risk level, tolerance, tolerance and appetite and any other constraints that you may have that can impact the way you invest your money. By objective, we're talking about your expected level of return and how long you expect to invest your money for. Are you investing for the long term and you want to take that money out in the future when you're retiring, or you want to invest for the next 5 years, for example, because you want that money to grow so that you can put it towards a down payment for your mortgage. So all these things that are personal to you will impact the way you allocate your money across these 3 different types of funds. So the higher level of expected return that you have, or the higher level of investment horizon, the more risk you can take and the more money you can actually allocate towards the riskier part of the 3-fund portfolio. So by risk level, you usually have the international stock market being most riskiest, and then you have the home stock market, and finally you have the home bond market. So that's the investment risk. But don't forget the other side of the risk, which is all about you, your level of risk tolerance and your level of risk appetite. Your level of risk tolerance is how much loss you can actually tolerate without being broke. So if the stock market or if your investment goes down in value, say by 30% or 50% over the short to medium term, is it going to be really troubling for you, or can you go about your life without it impacting you? So your level of risk tolerance will really be impacted by your age, your investment horizon, so how long you're investing for, any future liabilities that you may have, so do you need the money back to pay towards the mortgage down payment, and the stability of your income. So do you have a permanent full-time job and you don't really need to rely on your investment to pay towards your bills if something happens to your job? So that's the stability of your current income. But your risk appetite is all about your mentality, your personality, and how much risk you think that you can take. So if you like to take a lot of risks in life and have an adventurous soul, then your risk appetite would be pretty high. If your risk tolerance is lower than your risk appetite, or if you know that you are generally a high risk type of person, then focus on your risk tolerance level. What I mean is that you think you'll be fine if you put all your money in, international stock, but you know that at the same time your tolerance is not that great. So for example, if you're contracting and you don't have a permanent stable job, and you may have to pay towards a down payment towards your mortgage, then don't let that appetite influence the way you do your asset allocation. Focus on the tolerance level first. Vanguard has a very useful online questionnaire which you can take to help you identify your asset allocation level if you don't want to do it yourself. But for the purpose of this video, let me introduce to you a very basic rule of thumb of 100. It's a very conservative measure and helps you identify what percentage of your money you should be allocating towards the riskier part of the market. You basically take away your age from 100 and put that as a percentage into the stock market, and the rest will go into the bond market. Although given where bonds are currently right now, to me it makes more sense to use 110 or 120 instead of 100. So here's an example across 3 different types of risk level. If you're someone with a long investment horizon and a higher risk tolerance, then you can put 100% in the stock market and allocate 50-50 across home stock market and international stock market. And then if you're someone in the mid-range, then you can do 40-30-30 across home, international and bond market. And if you're someone with a very low level of risk tolerance, then you can do 20-80. So 20% in the home stock market and 80% in the bond home market. The reason why the home stock market has its own allocation in terms of stocks is all to do with investment risk. Usually international stock market is considered to be much more riskier compared to the home stock market, and it's all to do with FX, so what's happening to the currency. So as an UK investor, the US stock market is considered to be an international stock market, and so when you want to invest in US stocks or a fund, you first have to convert your money, which are in pound, because you get paid in pounds, into USD in order to buy those funds or those stocks. And when that happens and when you get your money back again, there is always an FX conversion. And what's happening to the market between pounds and USD will impact the level of return that you get back as a UK investor. But in practice, what's happening is that I don't think many of us UK investors would look at the US stock market and consider it to be riskier than investing in FTSE All-Share, except of course the FX conversion, as I have mentioned. So here is where I would differ a little bit from the original 3-fund portfolio system, and I wouldn't necessarily consider other developed market stock to be more risky compared to UK stock market, because in fact, if I think about it, investing too much money or a lot of my money into just the UK stock market is a risk itself. It's a concentration risk that you're taking on the country. So in order to avoid any concentration risk with home stock market, I would much rather allocate money across the developed market, emerging market, and the bond fund, because actually emerging markets are generally more riskier because they have idiosyncratic country risk. So what's happening to different countries would impact the market, and their FX or their currency is much more volatile than, say, GBP. So emerging market stocks are actually, indeed more risky compared to developed market stocks. So that's something to be mindful of when we are thinking about asset allocation. Okay, so the part 2 of building the 3-fund portfolio is all about fund selection. So which funds do you want to use to represent the 3-fund portfolio? So while picking this fund, there are 2 important things I'm going to consider. Firstly is the fact that we are a UK investor, and secondly, where we are with the bond market, given yields are so low. I will only be allocating to bond if we need to out of necessity or because we need a stable level of income. Here's an example of 3 different individuals and their fund allocation. Person A is 25 years old, has a stable job, has a high risk tolerance and appetite, so they don't have any big liability coming up in the future, and they won't be selling their investment out of panic when the market drops by, say, 30%, and so they prefer to have a high risk, high return characteristic in their funds. For this person, we can do a 100% allocation to stocks and split this allocation 30-70 between home and international stock market. So from Vanguard's website, we can do 15% in FTSE 250 ETF, 15% in FTSE 100 index, and 70% in FTSE Global All Cap Index. Vanguard's Global All Cap Index has exposure to the small cap part of the universe, which is why I prefer this index compared to, say, FTSE All World Index, which does not include any small cap stock. And small cap stocks generally tend to have a lot of growth characteristic in them. Although they're high risk, they also can provide potentially higher return. Now moving on to person B. This person is 40 years old, has a stable job, a moderate level of risk tolerance, so they don't have any big liability coming up, and they won't panic sell investment if the stock market drops by 30%. However, they do want to retire in 15 years' time. This person has a moderate level of risk tolerance but a very high risk appetite. So we can have an asset allocation of 75-25. 25% can go into FTSE All Share Index, 50% in FTSE Global All Cap Index, and 25% in Global Aggregate Bond ETF. This bond fund has investment grade or credit as well as government bond. Given the low level of interest rates, government bond alone cannot give yields. Therefore, we need to invest in IGs or credits. Investment grades are basically very high level of credit investment. So when you're investing in government bond funds, you're lending money to government. When you're investing in a credit fund, you're lending your money to different companies. And those companies can be classified in different ways. For example, investment grade or high yield. Investment grade companies are those with the highest amount of rating. So they're the safest types of investment within the credit market. So by investing in credit as well as government bonds, you can actually have a little bit of higher expected return compared to just investing in government bonds. Now, finally, person C is 60 years old. He is retiring soon, has a very low risk tolerance. Basically, they will need the money to pay towards their retirement cost in few years' time, and they also have a very low risk appetite. They prefer to have stable return and income compared to high growth. For this person, we can do a 20-80 allocation. So 10% can go into FTSE All Share Index, 10% in FTSE Developed World ex-UK Index, and 80% in Global Aggregate Bond ETF. So the idea behind this portfolio setup is that every year you will rebalance your portfolio to get yourself back into the target asset allocation until, of course, your situation changes or it's been a couple of years and you're very close to your retirement age. So that was the idea behind Lazy Portfolio, which you can build yourself. However, if you're someone who don't even want to think about asset allocation and decide on which fund to invest in, you can always choose Vanguard's lifestyle strategy funds or even the target retirement fund, which will do that job for you. Well, that's all for today. I hope you found this video useful. Until next time, look after yourself and your